Alright, welcome to the top 5 charts of the week. And in this video we're just going to walk through this email. It's a set of charts that I select from the blog and social media every week, so it's a good way to keep a track of what we're doing. And the purpose of this video is to go through, add a little bit of extra explanation and a little bit of context and comments. So I hope you enjoy. First one is US stock market leverage. Now this is a combination of a few different things, and first of all it's worth noting right here. So many of you, if you're interested in this sort of thing, you're probably aware of the NYSE margin debt series, which is something that a lot of people have been following for a long time, and that's actually been discontinued, as I mentioned right there. And in its place has been the FINRA margin debt stats, which is basically the same thing, but they actually cover a little bit more of the industry with their statistics, so it is a positive move. Now this chart is showing margin debt, so net margin debt. It's also showing, adding to that, net leveraged ETF, so that's the assets under management for leveraged long minus leveraged short ETFs, and also net speculative futures positioning, and that's just the aggregated value of that across US index futures. And the end picture is a view of US stock market leverage, and if you look at, say, this period over the last sort of 5 years, there's been about a $400 billion increase in that, which is pretty substantial. And yeah, of course the stock market itself went up there, and so, you know, part of that lift would be down to just increase in the value of stocks. But you know, when it's been floating around zero for all of that time, you know, pretty much the prior 10 years, and then it surges by 400 billion, that's meaningful no matter what the normalized view looks like. So a substantial amount of leverage built up there, which you know, when you think about the market cycle, I don't think that the bull market, that the economic market cycle is over yet, but when it does, it just goes to show that there's quite a bit of leverage here, and that could get ugly when it unwinds. Number 2, this is institutional investor confidence, and this is from State Street. So most of you should be aware that State Street is a global investment business. They do a lot of different things, but the core of their business is custodian, and that's basically holding money on behalf of others. And their business here has become, you know, well over $30 trillion. That's a lot of money. So it's worth saying that, actually, because sometimes, you know, you get lost with the a little bit lost with those large figures, you know, with the age of quantitative easing and all the rest of it. Sometimes you kind of lose track of what a billion or a trillion, you know, what is actually a large number. But I can assure you that 30 trillion is definitely a large number. And you know, being that size, you know, if you're looking at the data of what your clients are doing, you can obviously gather some insights, and what they've done is produce those insights quantitatively with this indicator. So when it's above the 100 line, it's on the right hand axis, it means that their clients are increasing exposure to risky assets, i.e. equities. And so, you know, coming back to the point of this chart, you know, looking at it, this is the global index versus global equity index. You can see there that it appears as though that they are, you know, buying the dip, which sometimes people put an F word in there as well. So that's interesting. It's you know, it might just be that they are rebalancing, but it could be active decision. Certainly interesting. I mean, I think that probably makes a degree of sense. Whether or not the bottom of this correction is in yet, and I talked about that in the weekly chart storm the other day, where, you know, the average duration of a correction from start to recovery can take some time. Number 3, this is the Finance Twitter Bond Sentiment Survey. So if you're not aware of these, every week I do a survey on Twitter. That's at Callum_Thomas, where I ask respondents their positioning and view on equities and bonds, and basically I ask them to say, because Twitter only allows you to have 4 options in a poll, which is interesting decision that they made there, I don't know why, but because they only give you 4 options, I've gone for, you can be either bullish or bearish. So some people have asked that I should put in a neutral, but well, gets them off the fence, I guess. So you can either be bullish or bearish for fundamental or technical reasons. And the results, so I haven't actually shown the split out between fundamentals or technical sentiment in this particular one. There is, if you click that link there, it takes you to a bit of a walkthrough. But anyway, you can see that this is the overall netball spread. So total bullish responses minus total bearish responses, and I've got the 10-year bond yield shown there inverted. So it's, because as you recall, bond yields move inversely with price, so it looks more like a bond price there. And interestingly, there we've seen quite a big turnaround, and it's not just in the last week, but over sort of the last couple of months really. Big turnaround in bond market or bond sentiment there. If you took that one literally, you might say that bond yields, 10-year bond yield's going to go back down to 2.3. That's not my base case. I mean, I think that we do get a pullback here. Just need a little bit of a reset. I think that at least stable, if not higher, is the way that bond yields are headed. Right, and number 4, just sipping my morning coffee here. It's 7 AM. Right, China, macro, copper, and bonds. A lot going on in these 2 charts here. A lot going on with the individual components as well as the overall conclusions. So the one on the left is showing copper prices and Chinese 10-year government bond yield. You can see that both of them have rolled over, which is an important and interesting observation. We'll get back to that. And the one on the right shows the copper versus gold ratio and the US 10-year bond yield, and you can see there that ratio, there's a lot of people talking about it for a period there when it was sort of foretelling that surge in the 10-year bond yield, and now that one's actually rolled over as well, and you can see that the 10-year bond yields also started to roll over, so it very much ties in with the previous chart. So yeah, I guess on China macro front, my base case is that you do see some slowing there this year because, well, one big reason for that is that they've gone from decisively stimulating their economy to less decisively stimulating the economy, and on some measures, monetary fiscal stimulus has gone from substantial tailwind to now partial headwind, certainly the rate of change at least. So a mild slowdown is probably what I would say to expect there, but even a mild slowdown there, because China is such an important economy, is going to produce ripple effects across definitely across commodities, and if you look at these 2 charts, then you'd argue also across broader markets, including global sovereign bond yields, global sovereign bonds in general rather. So it's one to keep on top of there. Definitely one for the risk radar. And last one is a what has been a very controversial chart. I put this chart up on Seeking Alpha. It also got published on Kitco, and yeah, it seems like gold is one of those really sensitive assets. The moment you go out there with a view either way, people are going to start, well, particularly if you go out there with a bearish view, people will, you'll ruffle some feathers. And, you know, I actually find that quite valuable to get interesting, shall we say, interesting feedback onto whenever I put an investment view or market or economic view out there, and if people start reacting to it quite intensely or quite negatively, it can tell you quite a lot. But anyway, into the chart, it's showing you US real 5-year yields, and that's taking the US Treasury 5-year yield and taking the 5-year inflation swap from that. So it's a pure market-based view of where real interest rates or real yields are. And it seems to have a pretty decent inverse relationship to the gold price. You can argue whether it's lagging or leading, and that may change slightly across time. But at the moment, and the headline is, of course, that if you took it literally, and it's dangerous to take charts like this literally, it could go below, or gold could go below $1,000, which would be a substantial move. You can see there is quite a substantial gap, and that gap is quite informative, interesting in and of itself. And by the way, the reason why real yields would be related to gold, because finding a correlation on the chart is one thing, but finding a correlation that is economically meaningful is another thing. The reason why is that gold does not give you any interest or cash flow, and because of that, if you're owning gold, your opportunity cost is to earn real interest rate, or cash rate, whatever. So if the real interest rate goes up, the opportunity cost of holding gold also goes up, and that's why you have that inverse relationship. And yeah, one reason for that gap could simply be down to risk aversion, heightened sense of geopolitical risk, political risk, a lot going on, a lot of noise there, a lot of things to be, a lot of shadows to be jumping at, but also a lot of things to be genuinely concerned about. So, the fear of geopolitical risk, the fear of a bear market could be the thing that's explaining that gap. And, it's hard, I guess, to take that fear out in short order, but if you did have a few series of positive headlines, positive changes, that risk premium could come out and gold could fall pretty quickly. So that's that, and yeah, I think that's all I wanted to say on that. And yeah, if you had any comments or questions, had anything to add, go ahead and put them in the comments section of the YouTube video below, and subscribe to the channel so that you don't miss out on any future updates. I'll be putting out a presentation either next week or the week after on the global risk radar, so stay tuned for that one.